Alright, for this video I want to go over the IRS Form 8995A, but specifically we want to look at how and when we need to complete the Schedule A for specified service trades or businesses. So I've got the sample Schedule A here with our 8995A, and it is part of a larger return, so we'll go through all the relevant forms and schedules that you need to be aware of. And then in addition to that, I've got two slides here. The first one covers some background on the QBI deduction, the 8995A, and then the second slide covers more details on the fact pattern itself. So before reviewing this, you should be relatively familiar with the Section 199A QBI deduction. I've got some more simple fact patterns and basic videos, which I'll put links to those below. So if you're unfamiliar with the QBI deduction, it might be helpful to watch those first and then come back to this one. So the QBI deduction, 8995A or the Form 8995. So there's two different forms to report these items on your 1040. When would you use either one, right? So the Form 8995 is referred to as the simplified calculation. So you can use this version to compute your QBI deduction if your taxable income is below the relevant thresholds for the year. So in our fact pattern, we have a single filing taxpayer. If he had taxable income before the QBI deduction of $170 or less than $170,050, he can just use the 8995 simplified version. If you have income that's above that threshold, then you have to use the 8995A. Now, why is that important? Why does it matter? Well, when your income is below these initial thresholds, you don't have to worry about things like, do you have a specified service trade or business? You don't have to worry about W-2 limitations or UBIA limitations. So whatever your qualified business income is, you take a 20% deduction. It's still subject to the overall 20% taxable income limit, but the calculation is very simple because you don't have to worry about any kind of phase outs or other kind of calculations. When your income gets high enough and it's above these thresholds, now you've got a little more work to do, and that's what we see on the 8995A. So if you were to look at the 8995A and compare it to the regular 8995 simplified QBI deduction, that one is much shorter, right? You're looking at a page versus a couple pages. So much more complicated calculation when we have higher income, and that's what we're going to see in this example here. So the QBI and specified service trade or business limitations. So in this example, what we're going to have is a taxpayer that has interest only in SSTB. So he doesn't have non-SSTB or a mix of the two. He's got all specified service trade or business interests. And so we're going to see how that kind of calculation gets done in the Schedule A and why these limitations are in place. So there's basically three ranges to think about. So when your taxable income before the QBI deduction is below that threshold, again, the taxpayer can simply file the 8995, claim the 20% deduction. It wouldn't matter that the business interests were SSTBs. Even if it's an SSTB, if your income is below that threshold, you can still file the 8995, claim the deduction, and again, you don't have to worry about W-2 or UBIA limitations. So very, very straightforward computation. Now, when your taxable income before the QBI deduction gets over this initial threshold, but it's still below $220,050 and this is the 2022 year amounts, there's a $50,000 range there. If you're within this range, the specified service trade or business income, the deduction is going to be limited in some part. And this is because SSTBs have a phase out on their QBI, and then we also have reductions that need to apply to the W-2 and UBIA amounts. Now, if you have specified service trade or business income, and your taxable income before the QBI deduction is over this ceiling amount, you don't get any specified service trade or business QBI deduction. So SSTB amounts completely phased out after that range. Now, that's not the same for non-SSTB income. Remember, okay, very clear difference here. When you have specified service trade or business income above this threshold, all of that's phased out. You can't use any of it. But if you have non-SSTB income, you can still claim the QBI deduction. You just have to apply those W-2 and UBIA amounts as the threshold. So, okay, so very, very, very important there. So again, in our example here, we're going to have a taxpayer that's in this middle range. So what are these 8995A additional schedules? So we're working with Schedule A because we have SSTB income. Schedule B is used if we're going to make an election to aggregate certain businesses. Now, that is quite frankly quite rare, so there's very rigid requirements that have to be made to even be able to aggregate, and a lot of times it's not preferable to do so. Schedule C is a common one. That's also used to for loss netting purposes. So if you have one trade or business that has a loss, you have to apportion those losses against other positive QBI amounts. So that's done on Schedule C. And then Schedule D for patrons of agricultural or horticultural co-op investment. So in our example, again, we're working with Schedule A. In practice, you frequently see Schedule A and Schedule C. Schedule B aggregation, not so much, and Schedule D, not either. All right, so let's move on to the fact pattern here, and then we'll get into the 8995A. So in our fact pattern here, we got John Taxpayer works as a full-time business consultant, but he's also a passive investor in 2 partnerships and then 1 S corporation. All 3 of those businesses are going to generate QBI, and they're all classified as SSTBs. So when he gets his K-1s, he sees the Section 199A amounts, which are all here in this table, and they all indicate that this is a specified service, trade, or business. So he's got this first investment, a fake operating partnership, QBI 5,060, W-2 wage allocation of 1,000, and UBIA 0. Fake operating S corporation, and then he's got another fake partnership LP investment. And so he's going to need to use all of these figures to complete the 8995A and the Schedule A. All right, so at the end of the year, John is doing his return, and he finds that his total taxable income before the QBI deduction is $180,618. Now, given that John's taxable income before that QBI deduction is above the $170K, but below $220, he can complete 8995A and Schedule A to compute that SSTB limit. Remember, if his income was above the $220,000, the SSTB QBI income completely would be phased out, wouldn't get any deduction at all. But he's in this range, so he is going to get a deduction. It's just going to be limited. So when we look at the 8995A, it's a bit confusing because you have to jump around back and forth between a couple of the parts. And you almost stop certain parts in the middle and then come back to them. So if we look at the form here, I'll just go through how the flow is going to work first, not really get into the numbers, and then we'll come back into the numbers so we can kind of set the stage here as to how this is completed. But this is page 1 of the 8995A. You can complete part 1 where you list each trade or business, indicate whether it's an SSTB, you have the taxpayer ID number. But once you complete part 1 and you've determined you have SSTBs, which we do, you first skip down to Schedule A and complete this section first. So what we're going to find is we do Schedule A first, part 1, because we have investments that are not publicly traded partnerships and not PTPs. Once we have this section completed, we go back to page 1 and we work on part 2. Now part 2 is completed lines 2 all the way down to line 11. Then we stop here and we have to move on to part 3 for the phased-in reduction amount. So then we'll go through part 3 in this example. And then once this is completed, we'll come back up to part 2, finish part 2, so that'll be lines 12 through 16. And then after this is completed down here on line 16, then we'll move on to part 4 and compute the overall qualified business income deduction that John can then pass up to his return, page 1 of his 1040, where he actually claims that QBI deduction amount. All right, so that's going to be the step process here. So if we start with Schedule A, Again, we're completing Schedule A first because we have income from SSTB. So enter each QBI business, so flowing through from the partnership, the S corp, the partnership, the third partnership in its own column. And these amounts on lines 2, 3, and 4 are the gross amounts, so the unadjusted amounts that are coming through from the K1s. Right, so for example, we look at fake operating partnership LLC, had qualified business income of $5,060, W-2 wages of $1,000 was allocated to John, and then 0 of UBIA. So if we look at line 2, we have the $5,060 in QBI. The line 3 amount, allocable share of W-2 wages is $1,000. Allocable share of unadjusted basis immediately after acquisition of all qualified property, so the UBIA is 0. And so he enters the relevant details for each investment, right? So $1,480 was the QBI amount for the S corp, $2,007 was the QBI amount for the partnership, and there's the wage amounts. Now, once those are completed, then we move on to lines 5 through 10. So the taxable income that John had before his QBI deduction, so that's the $180,618. The threshold, given his filing status, is $170,050. So he subtracts the 2 out there. The phase-in range is $50,000, right, or $100,000 if MFJ. So we have the $10,568. Divided by the $50,000, and we get a percentage of 21.136%. Now the applicable percentage here on line 10, you take that figure, subtract it out from 100, and we get the adjusted percentage that we have to apply to these amounts of 78.864%. Now, each of these line items here, 11, 12, and 13, they represent the gross unadjusted amounts up here multiplied by this applicable percentage. So if we take 5,060 times 78.864%, we get 3,991. If we take the $1,000 of allocable W-2 wages multiplied by 78.864%, we get 789. So we do the same for all of these columns up here, and we get our new adjusted amounts from Schedule A, right? So these amounts, once we have the adjusted line items from 11, 12, and 13, they are now carried back up to page 1 of the 8995A in Part 2. So if we come back up here to the 8995A, Part 2, you'll see here the adjusted amounts that are flowing through from Schedule A. So we've got the 3,991 in adjusted QBI from this first specified service trader business. Line 3, we multiply this by 20%. We get a $798 figure. And then on lines 4 and then line 7, again, these amounts are flowing through from Schedule A. So remember, if we look, for example, column C here for this fake partnership, the adjusted amount of QBI was $1,583. The adjusted amount of W-2 was $79. And so if we look at column C up here, we've got the adjusted QBI amount $1,583. And then line 4, allocable share of W-2, we've got our $79 figure. So you want to carry all those adjusted amounts from Schedule A to this Part 2 section, and then complete the rest of the line items based on the math that it's asking you for, right? So, for example, the W-2 wage limitation here, multiply line 4 by 50% and by 25% to get to lines 5 and 6. And then line 8, the UBIA amount, in our case it's 0, so if you do have some UBIA allocation, you multiply by 0.025, so a 2.5% allocation. And then just complete the rest of the line items down to 11, where you then stop, and then we move on to Part 3. All right, so Part 3 is the phased-in reduction for the W-2 and the UBIA amounts. So if we look at Part 3, notice what it's asking us here. So complete Part 3, so this section, only if your taxable income is more than 170, but not more than the 220. That's us, we're in this range. And line 10 is going to be less than line 3. So if I move up here, line 10 amount for column A, for example, 395. Line 3 is 798. So because line 10 is less than line 3, and the same applies for all of these here, we can complete part 3 for the phased-in reduction. So we're going to complete a phased-in reduction for every single SSTB because all of them had a line 10 amount that's less than line 3. And again, our taxable income before the QBI deduction is within this range. So for 17, 18, and 19, as it's asking us, pull these amounts up from part 2. So part 2, enter the line 3 amount. Now line 18, enter the line 10 amount from part 2. Subtract the 2 from there. And then line 20, again, we see our taxable income before QBI deduction is $180,618. We have the threshold. We subtract the 2. We get our same $10,568 figure that we had on Schedule A. And the phased-in percentage here, divide the 2, we still get our 21.136%. Now the line 25 phase-in reduction amount, it's asking us multiply line 19, so line 19 from each column, by the percent on line 24, and we get our adjusted amounts here. So $85 for column A, 20, and then $59 for column C. The QBI after the phase-in reduction, subtract line 25 from line 17. Right, so now we've got 798 minus the 85, and we get our adjusted amount of 713. Right, and then 213 for the S Corp, 258 for the last partnership investment. Now, as it's asking us here, once we have this value, enter this amount here and on line 12 for the corresponding trade or business. So these amounts now get reported up here on line 12. So we have our 713 amount, the 213, and the 258, and then complete the remaining lines as the instructions ask. So line 13, it's asking us qualified business income deduction before the patron reduction, enter the greater of line 11 or line 12. Right, so line 12 in this case is the greater amount, so we enter that on line 13. We don't have any investments in patron investments rather, so we're not going to have any values here. We didn't need to complete a Schedule D, right? So 14 can be blank, and then line 15 is asking us to subtract line 14 from 13 because that's 0. We just have our line 13 values here, and then we add all of these up for our line 16 total value. Now, once we have our line 16 value, now we can jump down to part 4, right, and figure out our actual QBI deduction that's going to be flowing through up to page 1 of the 1040. So the total qualified business income from all qualified trades or businesses, that's the line 16 amount that we saw up here on page 1. So 1184 transfers down here. If we had any income from REIT investments, so if you have Section 199A dividends reported on your 1099 div, you might have some 199A dividends from REITs, or if you have 199A QBI amounts coming through from PTP investments, you would see that on your PTPK1. You might have some amounts here. In our case, we don't, so we don't have any REIT or PTP components. So the 1184 is the only QBI amount that we're working with. Now the last remaining piece here is the overall 20% limit on taxable income. So after all this work is said and done, whatever your QBI amount is, it cannot exceed 20% of your taxable income. Right, so the taxable income before the QBI deduction is again the $180,618. We don't have any capital gains incurred during the year on John's return, so that amount is 0. And we have our 20% value here is $36,124, and clearly our 1184 QBI amount, that deduction is significantly less than the $36,000 cap. So we will be able to claim the full $1,184 deduction. We won't have this 20% limitation on taxable income. So now once that's all said and done, where does that number go? Well, it goes up on your 1040, right? Line 13, qualified business income deduction from Form 8995 or the 8995 dash A. So there's our 1184 amount. So that is a reduction to his AGI in arriving at taxable income. So that is how the deduction is calculated. So in John's case here, if we just kind of summarize here, what's important to highlight is, yeah, you have SSTB income, you've got income above the thresholds, and so your QBI deduction is limited, right? So his total QBI deduction was $1,184. And if we kind of think about this, for comparison, the total QBI for all these businesses up here, the 5,060, the 1,480, the 2007, was $8,547, and a tentative 20% QBI deduction would have been $1,709. So it is a greater amount than what we actually got to claim because, again, we have all those phase-in limitations that we have to be mindful of. So by applying these SSTB rules, the W-2 and UBIA limitations, the QBI deduction was lower by $525. Now, that's an important kind of teaching point because if John, let's say his income was not $180,000, right? So let's say his income was only $65,000. Taxable income before the QBI deduction was $65,000. Well, he's well underneath the 170. So John's QBI calculation would actually have been this, right? He would have had 8,547 of QBI. The W-2 limitations don't apply. The UBIA issue goes away. The SSTB issue goes away. So he would have gotten 8,547 would have been reported on the 8,995 at a 20% deduction and $1,709 in QBI deduction. So you can see how the taxpayer's overall kind of income and profile will really drive how this calculation works on your return. All right, so that covers it for this video. I hope that was helpful. If you have any questions, feel free to leave me a comment below. And as always, I look forward to seeing you again on the next video. Thank you.